remember between 2020 and 2020, early 24, you had this up, down in gold in a range, and you had silver in the staircase to the downside, overlapping. It would go down and go halfway back up, et cetera, et cetera. That tone has totally changed. Now it's all upside, but with pullbacks. So for silver, it's like 3 steps up, 2 steps back. For gold, it's like 1 step up or 2 steps up, 1 step back. Silver is always more erratic, okay? It gets punished more in the pullbacks than gold does, and then on the upside, it gains more. But even that type of behavior, which is different from the prior 3 years, it's a positive direction at least, even despite the pullbacks. I think it's going to accelerate to where you go up 5 steps and then pull back 1, not 2 steps, okay? And I think that tonal change will occur once asset flows start to leave the stock market bubble.
Throughout 2024, the price of gold has consistently broken records and reached new all-time highs, fueled in large part by economic uncertainty, global instability, and investor interest. This underscores its allure as a reliable investment in turbulent times. If you're eyeing the calendar, January, August, September, and December have historically been good months for buying gold. MichaelOliver, the proprietor of Momentum Structural Analysis, shares his insights on the precious metals and stock market potential. Michael states post-election market trends in this video, noting the S&P 500 and NASDAQ surge while gold and silver dropped sharply. Concurrently, he notes a significant shift in the precious metals, transitioning from a downtrend to an uptrend with occasional pullbacks. He predicts further gains for metals if stock markets weaken. Analyzing past market crashes can provide insights into the behavior of gold and silver prices. For instance, during the 2008 financial crisis, gold prices soared as investors fled the stock market. From October 2007 to March 2009, the S&P 500 dropped by over 50%, while gold prices rose from around $650 per ounce to over $1,000 per ounce. Similarly, silver, though more volatile than gold, saw significant price increases during this period. Earlier this year, Michael predicted a breakout for precious metals from their trading ranges. Since March, gold has risen from $2,000 to $2,650, and silver from $25 to $31.60. Many experts believe that silver is undervalued at under $30 compared to fellow currency metal gold. As discussed, their production and price ratios are currently incredibly disparate. While investment demand is higher for gold, silver has seen increasing time in the limelight in recent years, including a 2021 silver squeeze that saw new entrants to the market join in. With all major factors in play, MichaelOliver mentions rising U.S. Treasury bond prices, indicating a shift by cautious investors away from equities. He suggests this trend could signal market instability, potentially driving dramatic gains in monetary metals next quarter. Now, we present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
If you just look at if you bought the news, S&P, NASDAQ, like November the 6th, the day after the election, you had a massive upsurge, and November 5th and 6th, excuse me. The 2 days right after, you had this massive gap up type surge, and the metals, monetary metals, did quite the opposite. They collapsed. Silver and gold are trading now back above the price level they were when people sold the news. So if you sold the news of the election, Trump's going to defeat inflation, all this, you're losing right now. Silver and gold are actually back above those levels. S&P and NASDAQ are above the levels where if you bought the news, you're still making some money. Not a lot, but you're making some money. But it's interesting, the monetary metals have regained that loss and are trading higher than they were post the election. I think what's restraining, we still anticipate the monetary metals will have a vertical phase. You remember the monetary metals took off back in March. We beat the table. We said they're going to accelerate up out of this 3-year wide range. And at that point, silver was trading between $25 and $26. And gold was just above 2,000 yet again. It had been above it a couple times before. But this time it's different, we said. We're going to take off. And they did take off. I mean, gold's no longer 2,000. It's 2,650 area, trading right now as we speak on the front month contract. And silver's trading 31.60. Back then it was 25.26. And it's actually up more on the year, marginally right now, because the S&P's gained some of the last, since the election, and NASDAQ has. And gold and silver have cooled off. But they're still actually up year to date more than the S&P and the NASDAQ, which nobody realizes. They think it's, they got to be beaten, but they're not. They're actually up more than the S&P and the NASDAQ. And we suspect the key ingredient now to engage the silver and gold into a stronger upside is to break the stock market. I don't mean you have to crash it. Start to get the blood flow out of the stock market. Where the assets start to get nervous, they move elsewhere. And there's no time in history where when the stock market collapses, everything else goes down too. There's always some other place they go. And history has told us, 2000 to 2002, 2007 through 2011, gold went up with a break in 2008, but basically rose while the stock market went down. Same as the dot-com tops. Gold went up during that time. So did T-bonds. It was contra. It was a place to go. And if you'll notice in the recent 2 weeks, the T-bonds, which have lagged gold in terms of being an upside alternative, they've been under pressure. They turned up sharply. So somebody's buying T-bonds now. And it's not related at all to the Fed, because if you look when the Fed cut rates in September, T-bond prices went down, yields went up. So it didn't matter what the Fed did, the short end. But suddenly for the last 2 weeks, some asset managers have been buying T-bonds. Why? Are they nervous? Are they starting to vacate their stock positions? If we see any wobble in the stock market, I think you're going to see the monetary metals gain from that blood flow. And the next quarter could be very dramatic.
During an interview, MichaelOliver predicts a significant market realignment within 3 to 6 months. He explains that the Federal Reserve's rate cuts have historically boosted the market, but with a lag. Michael advises investing in tangible assets, citing the increasing demand for silver in emerging markets. He also warns of a potential 20 to 30% drop in stock prices, emphasizing the need for proactive investment strategies. Silver rates are expected to rise shortly amidst massive demand for metal for modern technologies and the severe imbalance between industrial consumption and mining output, according to a recent report by the Silver Institute. Fed Chair Jerome Powell has indicated that the central bank is in no rush to lower rates, citing a strong economy, a solid labor market, and persistent inflation, according to Trading Economics. Silver also faced additional pressure from Donald Trump's election victory, as markets anticipated inflationary policies and a more aggressive stance toward China, which could dampen demand for the metal. However, Michael warns that if silver returns to the 35 level, it will likely lead to a significant downturn. He advises investors to be cautious and expects a dramatic decline in the S&P 500 when silver and gold approach their prior highs. Let's get back to the interview.
It benefited the stock market in the dot-com bubble. Okay? You can look at the Fed funds rate chart then too. You'll see that they cut rates and a bit lag to that, the market took off. And then they started raising rates during late in the rally. And when the market finally topped, they started cutting rates again to save the market before it actually had collapsed, before the 2000 dot-com became a collapsing instrument. It was by 2002 before you realized it was really in trouble. And 2007 did not get bloody until late 2008, but they started cutting rates at the top. Now, they've already started cutting rates because they sense something. They see something in the data. And as we know, Powell has said, okay, this inflation mandate, that's one thing. Well, we're focused on the jobs now. And he knows the job data is not good and is not getting better. So they've already shifted. But when you look back at their shifts that occurred at and shortly after those major tops, it did not stop the downturn. The money flow did not help at that point because they had already created the bubble that once it broke, reality took over and they couldn't stop it. Instead, that money flow that they created, the river flow, asset managers, instead of putting it into stocks, put it into alternatives. They bought T-bonds, they bought gold. And I think we're beginning to see that now. Already early this year, gold has exploded. Silver's exploded since earlier this year. And T-bonds are shooting back up again as if somebody wants them for some reason. And they have been moving almost weekly opposite to the price direction of the S&P and the NASDAQ. T-bonds have. And now suddenly they just shot up very strongly this week especially. Why? If we start to see weakness next week in the stock market, we'll see, the inversion still exists. So the Fed can do that and it won't help. That's what I'm saying. You don't want to ever take silver anywhere back near the 35 level again. Let me put it that way. We get very specific with our subscribers, and I can't give it out for free. Okay. But basically, don't ever go back to the highs again. Don't even approach them. Don't even go back to 34 again. Okay, if you do, you're not going to stop this time. And we suggest strongly that if you get back up there again, and then you get gold back up within $50 of its high, you hit 2,800, you get back up in the mid 2,700s again. And I think we traded over 2,700 this week at some point. You get back up in the mid 2,700s, not even back to the 2,800 high. Don't count on the next advance being similar to the ones we've seen this year, meaning 2 steps forward for gold, 1 step back, 3 up for silver, 2 steps back. Expect something far more dramatic. And we bet that when that occurs, when silver and gold percolate back up toward those levels, the prior highs, that you're going to see the S&P oozing down toward what I mentioned a while ago, toward those levels aren't far below. And that is, I think, the key factor in igniting the metals into a more vertical phase.
Gold and silver have historically been essential assets for preserving wealth during economic uncertainty. In 2025, these precious metals are set to continue playing a crucial role, with market analysts and astrologically influenced insights suggesting significant growth potential. Considering MichaelOliver's predictions and the current market trends, what strategies can investors employ to balance their portfolios and mitigate potential losses in a market downturn? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.